Hello, my name is Brian Mills and welcome to my channel. One of the most basic and commonly used terms in all of investing is the price to earnings ratio, more commonly known as the PE ratio. Today, we will discuss the PE ratio, what it is, what we can gain from it, and how can we benefit from it. When investors look to purchase shares of a company, they perform evaluations of that company. They want to know if the price is too low or too high to purchase. When evaluating the company, the first metric most evaluators review is the PE ratio. The PE ratio is measured by calculating the stock divided by earnings per share. Now, you will never have to work this number out. It can be found on every financial website. Now, let's take a look at company XYZ. This company has a stock price of $20 per share. The annual earnings per share is $2. This will give the company a PE ratio of 10. Now, when reviewing the PE ratio, the magical number is 20. If the PE ratio is between 10 and 20, it can be considered to have good value. Stocks with a PE ratio above 20 can be considered overvalued. Now, the stock price doesn't tell us anything about the value of a stock. So investors use indicators like the PE ratio to help identify whether the company has value. When you're new to investing or lack basic knowledge or understanding, it may feel better owning 50 shares of a stock at $3 versus owning 2 shares of a stock at $75. Now, that company trading at $75 could have greater value and grow at a much greater rate than a company at $3. Now, let's take a look at these two examples. Company A's stock has a share price of $100 per share. The annual earnings is $6, giving it a PE ratio of 16.7. Company B's stock has a share price of $20. Now, the annual earnings per share is only 75 cents, giving it a PE ratio of 26.6. Now, which company do you think is the better buy? You know, when performing your evaluations of companies, it is important to understand the company's business and the sector in which it operates. Now, if you're unfamiliar with the 11 sectors of the stock market, I have a video of that breakdown. Now, companies in the utilities or real estate investment sector, they tend to maintain very low PE ratios because they pay out their earnings to shareholders throughout the year. The technology sector is considered a high growth sector, so you can find the PE ratios as high as 75 or 100. Now, in the tech sector, investors will buy these companies with high expectations and expecting greater returns on their investment. And in this sector, it is a great way to create wealth. But the last thing you want is to be caught in this stock when it falls or fails to meet expectations and the share price declines 25 to 35%. So knowing what's going on with your investments are important. And there you have it, the PE ratio. Thanks for watching. Be sure to leave a like, comment, share this video, and come on back for more wealth building information. Peace.